What's going on, everybody, and welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Make sure you please subscribe. Make sure you listen to this episode from start to finish. I promise you, you will not regret it. Please note, anything discussed in this episode is not financial advice, so please do your own research before investing into any stock. If you want some free money for your portfolio, Webull is going to give you some free money. It's going to give you up to 12 free stocks valued at up to $3,000. This is what I need you to do. I need you to click the link in this description. I need you to open up a Webull brokerage account and deposit any amount into the brokerage account. Webull will give you up to 12 free stocks valued at up to $3,000. Please, if you want some free money to start your portfolio, especially if you are a beginner, go ahead, click the link in the description, get you that free money. In this episode, we're going to be discussing my particular trading strategy when it comes to the stock market, because it's very, very important for you to understand this. In the Trade for Yourself portfolio, I've been outlining certain trades that I've been in this particular year, and I want to let you know why I'm selecting these particular trades. Let's go ahead and get into the trades that I'm in right now and the thesis behind what I'm doing in the stock market in terms of trading. Let's get into it. Okay, everybody, so let's start this episode off by showing off the trades that I am actually in. This is the Trade for Yourself portfolio, and I'm going to make it my business to show you what this portfolio is doing and the particular trades that I am in. Now, if you want to know what I'm actually trading Advanced Micro Devices, ticker symbol AMD. AMD is a semiconductor stock. So the top trade, I'm trading the AMD October 2023 expiration for the $140 strike. Currently, I'm up 9% right now and up about $36. And I'm trading another AMD trade for the January 2025 expiration for, again, the $140 strike, which I'm up about 28.99%, and I'm up over $968. So in total, with active positions, I am up over $1,000 in active positions. Now, in order to understand why I got into these particular trades, you're going to have to look at the charts, and you're going to have to stick throughout this video for the entirety in order to be able to see those charts. But what I want to tell you, if you've never seen this before, I am trading options contract. And in order to really truly understand what I'm trading, I need to truly and thoroughly explain what are options contracts. Okay, so again, if you haven't seen that terminology or seen those things before, again, what are options, right? Options are financial derivatives that give buyers the right, not the obligation, to buy or sell an underlying asset at an agreed upon price. When you purchase an option, you are purchasing a contract, and each contract represents 100 shares of the underlying asset you select to trade. Pretty much what that means is that if you just take shares, right, and you look at a share of a stock, if you purchase a stock for $100 and that stock price goes up $1, you will then gain $1 for however many shares that you own. Options do not work like that. Options are leveraged instruments. And when you are trading options, you are purchasing a contract that represents 100 shares. So what happens is that when the stock price moves up $1, it's not just going to move up $1. It may move up $50. It may move up $75, depending upon certain elements of a particular contract that we're not going to get into in this particular video. But understand that options are leveraged instruments. And so you trade them because they allow you to get more volatility, and they allow you to make more money because it represents 100 shares instead of just trading share for share. Now, there are three important elements of each contract that you must know before purchasing. You must know the premium, the strike price, and the expiration date. So let's talk about all three. The premium. The premium is the price that you pay to buy the contract. So for example, if you see a premium on an option chain that is $5, it's going to cost you $500 to purchase one contract. And that's why, and here's the reason why. The breakdown is you take the $5, multiply it times the 100 shares, right? And then you get the $500. That's how much it costs. The strike price is the price in which you buy or sell the underlying asset, which is also known as the exercise price. In other words, the strike price is the price that we want the stock to reach. But it's not only the price that we want the stock to reach, we also want the stock to exceed the particular price, because it means that we are in the money and we can get deep into the money, which means that we're making more money. We'll get into that later. Expiration date is the date that the contract expires. If your contract expires in the money, you can purchase 100 shares of the stock at the strike price of the contract. If your contract expires out of the money, your contract becomes worthless, resulting in a loss of your entire investment. That's why we have to understand that these particular trades have expiration dates on them, meaning that we can't be in them forever. But now we're really truly going to get into my trading strategy and how I choose to trade in the stock market. Now, the way that I like to trade, my particular trading strategy is by utilizing leaps in my trading portfolio. So what are leaps? Leaps are long equity anticipation securities with expiration dates that are 1 year or longer from the date you purchased the contract. Some leaps can be up to 3 years or longer in some cases. Selecting contracts that are 1 to 2 years from expiration is where you want to begin surfing the chain. That means looking for certain contracts and certain elements of certain contracts that you may want to choose to trade. Now, trading longer dated options allow you to benefit from the prolonged trend of an underlying asset. Also, you get the benefit of having time on your side and allowing your thesis to play out, so you don't have to worry about the day-to-day volatility of the market, because the market is going to move up and down all the time, and the effect of theta is very minimum when trading leaps. Theta is the Greek that pretty much is talking about time decay. The closer your expiration date is, the more theta is going to be so critical, because if the particular stock goes in the wrong direction, you could potentially lose more and more and more money when trading options. That's why I like to trade leaps. And typically the returns you can expect on leaps are 100% or better. Now, what are the pros of trading leaps? Now, it's very easy to make $1,000 or more trading these contracts. I'm just gonna be 100% honest with you, because these contracts can become extremely valuable and the traders can hold these for longer periods of time, especially as they get deep in the money, because again, we're trading contracts that have expirations of a year out or more. So that gives us the opportunity to make more money because we may be holding them for a longer period of time. Again, you can hold these contracts throughout volatility in the stock market as long as you bought your contracts at a good price. You can't just buy these contracts at just crazy prices and think you're going to make money. You still have to be strategic and buy your contracts at great prices. Pros, you are giving yourself time for your thesis to play out. The one thing that I've learned in the stock market as I've grown is that I understand how to evaluate a company. I understand the elements of the market that makes the market go up. I understand the elements of the market that makes the market go down. I understand what makes a company good, what makes a company bad. I understand how to read a chart. I even can understand where a stock price is going to go. The problem that I have and the issue that I have is figuring out how long is it going to take for it to get there. When you purchase leaps and you buy yourself time, you are reducing the risk of picking the wrong strike price, or not the wrong strike price, but picking the wrong expiration. Pretty much a stock could reach your particular price, but you may pick the wrong time frame, and then that may cause you to lose money. Broadening your time horizon is what is going to give you the best opportunity to make money. And at the bottom in bold, it's easy to take profit off the table and let your winners win. If you buy 2 contracts and your contracts go up 100%, you can easily take 1 contract off the table, put it on the side, reposition, wait for your next trade, and allow that particular option to continue to print and continue to eat, right? Cons. Everything has a pro and everything has a con. The first con is that the premium you will pay is larger than shorter dated contracts. When you're trading leaps, depending on the stock price, you're gonna have to buy at least $10, right? Which means that whenever you're purchasing a premium, it's probably going to cost you at least $1,000 per contract, if not more. Because when you're trading leaps, you have to buy quality contracts. You cannot buy contracts way out the money and expect to make money in this situation. You have to be strategic. So you're going to pay more for the premium than shorter dated contracts. The capital that you put to risk will be tied up for longer periods of time with no guarantee of a return. Look, these contracts still have expiration dates, and it does not mean it's going to hit just because you broaden your time horizon. So you have to understand that you have to put a substantial amount of capital up, and you have to be willing to wait. When you put that capital up, I don't need you to need it, right? I don't need you to have to need that capital in order for you to put it up, right? And number 3, options are still very volatile, even trading in this method, and they can move very violently. I cannot put into words how trading them will make you feel. You have to put money on the line and experience it for yourself. And so you have to understand that when you're trading options in general, but you have to understand that when you're trading leaps, because you're putting capital on the line, and you're putting a substantial amount of capital on the line if you actually want to make money. So let's go ahead and get into the AMD example and why I got into that particular trade. Okay, everybody, so here's the chart of Advanced Micro Devices, ticker symbol AMD. And we're going to explain what I saw that made me feel that AMD is going to reach $140 per share within the next few months, within the next year. Now, the first thing I want you to notice is where the low is on this chart. Now, AMD made a 52-week low of $54.57. But since it made that low, the stock has been able to show positive structure. What that means is that the stock has continued to make higher highs and higher lows. Higher high, higher low. Higher high, higher low. Higher high, higher low. What does that mean? When the stock is continuing to make higher highs and higher lows, that means that the particular stock is on an uptrend. It's bullish. That gives you the license, to look for opportunities to continue to trade this stock to the upside. Now, it's very, very key to understand something here. And right here in May 24th, AMD stock gapped up, and a gap appeared, and I highlighted this by this yellow rectangle, okay? And AMD stock gapped up. It gapped up because of NVIDIA. Full disclosure, the stock gapped up because of NVIDIA. So AMD went up. It went up to $130, came back down, consolidated some, and went up to $132.86. And it fell back down and it filled this gap. But it still respected a key area of resistance, right? Resistance turned to support right here. And so what I said, look, AMD is continuing to make higher highs and higher lows. I'm looking at this, AMD broke out. It broke out, but now it's coming back down and it's retesting the level that it broke out from. And so I said, hey, I'm going to get an AMD right here. I'm going to get an AMD right here at $108. And my first target is $132.86 because I believe that AMD still has more upside to the stock. I believe that AMD is going to outperform in its earnings in the second half of this particular year. I believe that AMD is going to be one of the best performing stocks in the second half in terms of technology and the NASDAQ as a whole. So I'm saying, hey, I'm going to buy this particular stock at 100. I'm going to buy this options contract by the $140 strike And the first target is that I'm going to trade it up to $130.86. This is key resistance here. I think AMD is going to break this resistance and is going to make it to another key resistance level of $141.25. Because look, I believe in AMD fundamentally as a company. I believe it's going to continue to grow, but I'm also just looking at the chart. I'm just looking at it technically, right? The stock is continuing to make higher highs and higher lows, and it's moving up higher. I feel good about holding this particular trade for a long period of time. Why? Because I bought it at a great price. When you buy things at a great price, you are not worried about the volatility and everything that's going on. You're going to allow everything to play out. If AMD is to break this and actually break down below this, then I have to start questioning my thesis in terms of if AMD can actually get up here. But as long as AMD continues to make higher highs and higher lows, I have no doubt AMD is going to reach my target and exceed it to this next key resistance level. This particular trading strategy can help you make a lot of money, but it can also cause you to lose a lot of money if you are not careful. That's why it's very, very important for you to stay tapped into the Trade for Yourself podcast and the Trade for Yourself portfolio, so I can walk you through the certain trade that I am in, so you can kind of see my mindset around my particular trading strategy. Okay, it's very, very important for you to understand that, because I'm going to be walking you through this, but you need to subscribe in order to be able to get that information. As always, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like, please subscribe. Let me know if you like this particular trading strategy. Let me know if you have a different trading strategy, because I want to be able to learn and understand how everybody trades, okay? But I want you to understand how I trade, because this is what works for me and what I believe can help you be successful. As always, remember, don't pay for it. Trade for it. I'm going to tap in with y'all in the next episode.